You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRoque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Thank you for being here and listening. Thank you for sharing the podcast. How soon can I take a loan out against my policy? This is a pretty common question that I hear often enough that I thought I would do a podcast on it. A lot of people seem to have the misconception that it will take a few years to be able to access their cash value, even up to 5 years. But actually, and I certainly can't speak for all companies, but the ones that I have experience with, the companies that I work with actually allow you to access your cash value in the form of a loan basically right away as soon as you fund the policy. It's always been that the easiest way is to wait at least 15 days before trying to access your cash value from premium dollars that were just paid into the contract. Lately, however, they've been saying more like 7 business days. So I would just say 7 to 15 business days to be on the safe side. So don't expect it to be super easy. If you just send the premium in and you're like, oh, it's 7 days, it might be a little longer than 7 days before you can access premium dollars that were just sent in. However, it is actually possible to access those funds even sooner than the 7 to 15 days I just mentioned. It's just to be able to do that, the company is going to want a screenshot or some sort of bank snapshot of your account showing that the payment went through on your end and the balance, make sure it didn't bounce and all that, make sure there's some identifying information that it's your bank account. So it is possible to access the money sooner, but it is a little more tedious for you. You have to send information to be able to confirm to the company that everything's all good on your end. And then you'll be able to request those funds. I think it's easiest just to go ahead and wait the 15 days, unless you have some sort of really pressing reason or need. I think it's best just to wait those few days before asking for it so it's more easy for that to be taken care of. And honestly, if you're starting a policy with a monthly base premium and a monthly paid-up additions premium, because remember, those two can be separated and paid separately on 2 different premium modes. But if you're paying them both on a monthly premium mode, it usually doesn't make sense to access the funds right away anyway. You're going to need to let it build up a little bit before there's enough in there to really bother to try to access those funds. Unless your payment's very large and you have a reason for it, then of course we can. But I say, generally speaking, if you have a monthly base premium and a monthly paid-up additions premium, you're not going to be trying to access those funds right away in the first 1 month, 1 to 3 months, 1 to 6 months. You might want to just let it build before you're trying to borrow against that account. In fact, if you're paying monthly premiums, I would suggest not even considering borrowing against that account until at least 6 months to a year have gone by. And then maybe we put a plan in place where we have a debt payoff plan or something you want to purchase. We just make sure we are looking at your goals and pulling money as needed for that. But generally it'd be best if you would wait 6 months to a year to access those funds for whatever your purpose is to take that loan. One of the services we provide at Alpha Omega Wealth Northwest is to put together a debt sheet for you. So if you have a few debts that you want to eliminate, and that is one of the primary uses for your banking system and one of the reasons you want to set it up so that you can pay off these debts and not lose the earning power of those dollars, then we would create this debt payoff spreadsheet for you, and we would go through each of those debts and how soon we could expect them to be paid off. Of course, it's a rough illustration. It's not perfect. But usually we're illustrating just taking funds from the account once a year. Now, they could be taken every 6 months or something like that, but once a year is usually makes the most sense. And then we attack these debts one at a time until they are all eliminated. And one of the reasons that I say we don't want to have to take loans frequently all the time, maybe once every 6 months or once a year, is because we have to keep in mind that life insurance companies are not like banks. They do not have bank tellers and people lined up waiting to do transactional business. Of course, they have client service departments and they absolutely will do whatever service we need with loans and loan repayments, but they don't have just a string of tellers, a whole bunch of people ready to process constant loans for our clients. And the thing is, we really don't want to burden the company with tons and tons of loan requests if we don't have to, just because that will end up, of course, making the company have to hire more people, which in the long run, I'm sure would lead to increased costs for the whole life policies because they have to service them more, or just makes customer service more busy. So then it might take a couple days longer to get your loan request because there's just so many people requesting. So we like to encourage our clients to not have to frequently request. If you foresee that you're going to need funds for certain things, we kind of look at those, lump them all together, and plan a time when to take those funds, when makes the most sense for you to take that loan and then address your needs from there. Now, don't get me wrong, you absolutely can make a loan request anytime you need one. It could be once a month if you needed it. So there's no restriction on that. We just like to encourage our clients not to make it a habit to do it all the time or to just plan, I'm going to take one once a month as soon as I start this contract. We just don't want it to be too frequent so that other repercussions, maybe higher costs or something, end up happening down the line. Now, for those who start their policies with an annual payment or an annual paid up additions payment, there will be a decent amount of funds readily available as soon as the policy premium or paid up additions has been paid. So in this case, it's possible that we may want to make a plan to borrow against the cash value as soon as the account is open and paid. Maybe you have a debt you want to pay off or more than one debt. Maybe you have a car you want to purchase, you've been itching to purchase, and you have the down payment ready to go. And so we can turn around and run those funds through your policy and then go make those purchases or pay off that debt. I've actually talked to a few people who have large amounts saved up in a checking or savings account for the intention of putting a down payment on a house, a rental property, or some investment type property, real estate property. And they have the funds just sitting there in their checking account. And so they absolutely can be used to fund paid up additions, just depending on the overall structure of the policy and what kind of ongoing base premiums you're able to maintain. Oftentimes we can use that money and run it through first before you're putting it as a down payment down on your rental properties or your house or your houses or vacation property or investment property. And it's best actually if you can run it through your policy first. And so, but people sometimes are like, well, I need this money right away. I want to buy this property. So depending on how long underwriting takes and how quickly you get through the underwriting on your end, the part that you're responsible for, then maybe that's possible to use those funds, run them through, and then access them right away to go proceed with that real estate investment. In this case, where you have a lump sum that you're going to use to fund the paid up additions, you're basically moving your money from one pocket to another. And the pocket you're moving it to is safe, it's guaranteed, but you're basically just moving it from one pocket to the other because that money is available right away, just as it was before in your checking or savings account. When you move it over to the paid up addition side, you are absolutely able to access that value right away for whatever you need. Of course, the 7 to 15 business days, but yes, but pretty quickly you're able to access that money. There's not a chunk lopped off for insurance costs or whatever because it's the paid up additions portion, and that basically goes 100% through. You can access just about dollar for dollar of all that money you put in. Of course, again, that depends on the company, the structure of their paid up additions, and if they do have a fee on some of their paid up additions, because some companies do, or some companies have a fee if you fund a super, super high paid up addition as related to the base premium. And so there are some extra detail around that. But in general, you have access to that money in full as you move it from your bank account to the paid up additions portion of your policy. And over the course of a few years, you do have access to the base premium as well. I'm not trying to say you don't have access to the base premium. It's just year one where you're not going to have access to that base premium and you're going to have access only to the paid up additions, pretty much. So if you have a lump sum of money that you've been contemplating putting into a policy and you also have another use for it, I certainly think that it's going to be much better for you to open up a policy and run it through on the paid up addition side and then use it for whatever purpose that you need it for, rather than just spending that money outright, just spending that money directly, just putting that down payment on the house direct from your checking or bank account, because you're handing that money over to someone else and you're never going to earn on it again. By running it through your paid up additions and then borrowing against your cash value in your whole life policy, you will be able to continue earning on that value for the rest of your life. And in the meantime, you're providing a tax-free legacy death benefit to your loved ones. I know some of you are not that concerned about that, so it's more like a bonus. That's a side effect that happens. But many of you do care about that and are grateful that in the process, you also are protecting your family, and it's going to leave a much, much larger legacy if something were to happen to you unexpectedly, too young, before you have the opportunity to use the funds how you wanted. In the meantime, you're protected and protecting your family. So, in summary, you are able to access the funds that are available to loan inside your policy right away. As in, you don't have to wait like a year or more before you can access your policy and start banking with it. But when you are paying your premium on a monthly basis, especially both the base and the paid up additions on a monthly basis, it will make more sense to wait at least 6 months to a year before starting to bank and borrowing against your policy. Well, I hope this was helpful information to you. We're getting a little more into the details in some of these podcasts, and I hope that it's helpful and useful for you. As always, I thank you so much for listening. I hope you have a great week. Thank you.
This is the podcastfactory.com.